This video has been a work in progress for at least 3 months now. In case you don't know, I'm Iranian, meaning I'm quite literally in the middle of war right now. I've scripted this video multiple times, never got the chance to record it. Before we start, for your own sake, get your attention span together, turn your phone off, put it away, get a piece of paper, get to listening and get to studying. This video quite literally goes through everything you need to know about the algorithm behind the market. Now, before we start, I don't claim to be the best at what I do. I don't claim to be the almighty and all-knowing. This is just documented through my years of experience trading the markets, through my years of experience mentoring students, and through thousands of trades. This is what I believe the system behind the markets. I'll be going through every single principle, okay? And if you have any questions, either comment them, but before you comment your questions, or you can also join my Discord and contact me there, where I'm extremely active. If anything, I'm reviving my server at the moment. I'm reviving everything. I was gone for 2 months because of the war, but I'm slowly coming back now. If there's anything you want to know, any questions you've got, leave those questions for after you finish watching the video, because most likely I've covered your question in the video. There's a lot that we're going to go through. OHLC is the foundation of price. Open, high, low, close, or open, low, high, close. OHLC refers to the 4 parts in a candle that run the markets. Candles run the markets. And you may be questioning, it can't be that simple, is it? It is that simple. The system behind it may be a little complicated for beginners. That's why it's better if you have some understanding of ICT concepts, some experience in trading before you watch this video. But even if you're a full beginner, I've made it as simple as possible for everybody to understand. Before we get into, candles, you have to first understand some theories. And these theories aren't just theories, they're facts, but they're more like things that you need to know on paper, things that you need to have in your head. One of the principles that the market is ran by is time. Everything is ran on time, and the markets are ran on time. Meaning, it's not just price. Meaning, it's not just candles. It's candles that are formed through price, and every single thing that we talk about in this video is formed via time. Okay, so the script, imagine some programmer sat on his laptop and decided to code the markets. The variable that decides when price does X or Y or Z is time. You need to understand this. Market runs in time. And the markets are fractal. Fractality is something I think everybody struggles with. This is a core mechanic of the algorithm that says every time frame is the same and every time frame runs by the same principles and laws. What do I mean by this? There's no difference except speed. Every time frame is made of candles. Time frame is meaningless. Only candles matter. 1 second time frame has the same laws as a monthly. You've heard many times that traders will tell you, hey, don't go on the 1 minute, it's gambling. Don't go on the 5 minutes, it's gambling. Higher time frames are higher probability. That's completely and utterly nonsense. Completely and utterly bullshit. Every single time frame moves exactly the same way. And in fact, I'm going to add something to this. The only difference between time frames is the time cycles they run by, the timing of the draws and imbalances that they use. That's quite literally it. In other words, you can trade the 1 second time frame as you trade the hourly. You can use the same strategy. If you are a swing trader, you can take your swing trading strategy, which relies on the daily time frame, and apply it on the 5 second time frame, and you would be fine. If you don't believe me, go back test it. Now you might be wondering, what do I mean by draws and imbalances and time cycles? Don't worry about that. That's what this video is for. Right now, we're just getting the foundational understandings that you need out of the way. After this, every single question you have will be answered. OHLC. A candle is formed through OHLC. So in this instance, you have a green candle. This right here is the open. At the bottom, we have the low. At the top, you have the high, and then the close. But what is OHLC formed through? A candle is formed through 3 stages. These 3 stages are named the power of 3. You've heard the power of 3 before. Many people say, people give it different descriptions, but the reality is the power of 3 is just a system that forms a candle. If you think about it, when we open, that's your accumulation. Then we move lower, that's your manipulation. Then we go higher, that's your distribution, and then we have the close. All the power of 3 does is it forms a candle. You've probably went on YouTube, you've seen many ICT kill zone strategies, blah, blah, blah. Every single strategy out there, relies on the daily power of 3. ICT traders like to trade the 930 open. The 930 open is where we go from making that low to making that high. Again, time, guys. The market runs on time. The daily OHLC is where you're pretty much trading every day. Now, again, you're trading the daily OHLC. The daily manipulation to distribution. You could also trade the hourly 930. Sounds weird, doesn't it? Times fractal. So, for instance, we have 24 1-hour candles on a daily candle. If you go inside of a 1-hour candle, we have around how many? We have 12 5-minute candles. Each of those can be an hourly candle of their own. That's exactly how the market runs by. That's exactly how the market runs. It's an infinite division of boards. It's an infinite fractality phase. So if you go on Google right now and look up price, if you go on YouTube or just Google and search up fractality, you're most likely going to see something like these, right? This is the most known one. You can find stuff like this. And this is quite literally how markets are ran. The more you zoom in, the more you see the same pattern. Okay? Doesn't matter how deep you go in or how far you go out. It's an infinite pattern that constantly repeats. There is no difference whether it's the 1 second, 1 minute, 5 minutes, 1 hour, 4 hour, daily, weekly, monthly. It doesn't matter at all. A single candle is run the same way, no matter the time frame. So time is fractal. This GIF right here, this video right here, very well represents the markets very well. So if you're ever confused about price, come back to this. So now we're back on Myo. Continuing here. Before we come down here and go into detail, we have to understand liquidity. And if you don't know what liquidity is, in very simple, well, honestly, you should know what liquidity is if you're on this video. This video kind of helps with the connection of every single concept you've learned. So what ICT does is he teaches you some stuff, but he doesn't connect them for you. That happens through experience. And I went through the experience. And this video is me. Also, if you keep seeing me pause, that's because I have a double espresso next to me, a bottle of water, and I have some cigarettes right here. In fact, I just lit up a cigarette. That's great, isn't it? Liquidity is basically the stop loss of traders. So, for instance, if you're long, your stop loss is on a low. If you're short, your stop loss is on a high. You have buy side liquidity, which is so the best way to differentiate and understand what buy side and sell side is that when that area is hit, you have to buy. So if you're in a short and your stop loss is hit, you're buying to get out of your short position. If you're in a buy position, you're selling to get out of your buy position. So sell side liquidity is lows and buy side liquidity is highs. Okay, because what do you have to do to exit out of that trade? You have to either buy or sell. For buy trades, you have to sell. For short trades, you have to buy. That's pretty much what liquidity is, okay? And the market makers love liquidity. They love stuffing traders out. And that's probably what you've heard a million times, right? Even ICT says liquidity, liquidity, liquidity. Even every single mentor out there, every single YouTube video out there talks about liquidity and how the market loves to hunt traders. But I disagree. I believe liquidity doesn't exist. Liquidity does not exist, my friends. So no matter how many lot sizes an institution buys, the market is not going to move. All price wants to do is offer those liquidity levels. Now, let me explain it to you in a different manner. ICT, when he first started talking about liquidity, he used liquidity as a metaphor for premium and discount. So when you refer to liquidity, it's way easier to understand and way easier to somewhat look for on the charts than premium and discount. It's just another metaphor for highs and lows and premium and discount. Market doesn't actually care about your money. The market is run algorithmically. Okay? When we say algorithmically, it means that no matter how much you buy and sell, actually moves the markets. It doesn't. When we say algorithmically, it means it's designed to do a specific job. Okay? And when it's designed to do a specific job, that's literally only what it does. The market hunts those levels for premium and discount pricing, not to take you out. The market does not care about you. The market does not care about your stop loss. Liquidity is just a metaphor. It's just another word to make premium and discount simpler and easier to understand, so that you trade based off of premium and discount without realizing it, without going into detail about premium and discount. That's all it is. The algorithm is built for market makers. Well, what the hell did I type here? That's what the algorithm is built for. Market makers want to buy cheap and sell expensive. It's as simplified as that. If you're a bank, if you're BlackRock, if you're one of those big guys, you don't want to buy when price is at an all-time high. That's what the engine is for. The engine says, okay, we're extremely expensive. Let me retrace a little lower. Let me go a little bit lower so that price is cheaper. So then my creator, the people behind the algorithm, can buy when price is way cheaper. They buy cheap, sell expensive. They short expensive, get out, discounted. From discount to premium. From premium to discount, from discount to premium. Lows and highs do that. That's what the algorithm is built for. So here, imagine this line right here is a low, and this line right here is a high. Price is programmed to do this on every single candle and every single time frame, and it's mentioned with time fractality. And it does this through a process called the power tree. So here, I'm actually going to draw a little bit to help you understand this more. So I'm going to use this green color right here. So imagine that, let's first finish this move right here. So imagine it does this, right? That's the whole move. The candle here would look like something like this. So if this is your open right here, we would open right here. Then we would trade all the way down to here. So this right here would be wick, right? And then we trade all the way up here. And let's say we come back a little lower and close here. So your candle will look something like this. I forgot how to draw candles, but Jesus Christ, it kind of messes with your brain, man. Sorry. Because I had to look at how much we have to go through. So I literally forgot how to draw candles. But your open is here. Then price moves all the way lower here. So we open here. This is your low. OLHC. Do you see what it did here? It first retraced all the way lower into a discounted area. And how do we determine that discounted area? We do that by lows and highs. So if this right here was a low, and in fact, to help you a little bit, I'm going to draw, like, let's say, like a green candle here, right? This is a green candle. And this right here is the low of that candle. This right here is the high. And this right here is a new candle. You know, we open right next to it. We move all the way lower, below the low of that previous candle. So that's your drawn liquidity. That's your liquidity level. When in reality, there's not really anything related to liquidity. In reality, all it is discount levels. So when we dip below that level, we are discounted. Market makers love discount levels. They buy this discount level, open, low, again, open, low. They trade that all the way to the drawn liquidity on the other side. Open, low, discount, high, premium, and then the candle closes. Pretty much all that this is. Let's go over here now. OHLC is formed through a process called the power tree. The power tree, as the name suggests, is made up of 3 parts. Step 1, accumulation. This refers to the candle open where price doesn't have much movement and accumulates as much liquidity as possible to prepare for the next phases. So this right here would be, my mouse is messed up, I'm sorry about that, I gotta give me a new mouse. This right here is your open, right? This is where the candle opened. Before we move to set in the low, which is right here. Open, low. Give me a second, I gotta turn my phone off and then we can continue. My bad on that. So the accumulation is literally just the open. It's what price does before it moves to either the low or the high. And obviously I'm using OLHC to use as an example, which would form a green candle. But the same thing applies, obviously, to an OHLC, which is a red candle. Open, high, then low close. Manipulation. After we open, we run to set either a high or a low in. The first direction we go to is called the manipulation, and it usually targets a high and low that has liquidity sat on it. So right here, I've drawn this here to help you understand this a little bit better. So your open is your accumulation. And then your low is your manipulation. That looks like a dick. And then your high here is your distribution. And you might be like, wait, Androgen, is this level right here our distribution? No, this whole up move here is your distribution. This whole down move here is your manipulation. And this whole move here is your accumulation. Okay? And then at the end, we have distribution. After we set a low or high, distribution comes in where we rush quickly. This is the best time to trade to set the other side in, high or low. So for example, if we set a low in, we want to set a high in. If we set a high in, we want to set a low in. Manipulation is to find entries, distribution is for execution. Here I've drawn an example again. So a candle right here with our draws on liquidity. This green candle right here opens. This is your open and your accumulation. Then it starts to move lower, right? As you can see, it starts to move lower right here. After we dip below this low right here, which is our drawn liquidity from before, again, if you're a little bit confused, this whole price action here that I've drawn is the lower time frame price action of this candle. Okay, every single candle has a lower time frame price action in it. So, for instance, you could call this the hourly candle, and you could use this right here as the 1 minute candles instead of that 1 hour candle. Discount manipulation low. Here we are in the discount. We set the low end, so we're manipulating. Here is the best to find entries, and then here is to find executions. So right around this whole area. And then we move all the way up into premium. Where did my mouse go? Into premium, which is where we set our high end, which happens through distribution, which then sets a high end, and then we close. An important thing to understand here is that, as I said before, market is ran in time. A lot of times your strategy isn't the issue. It's the time that you execute your strategy on. You do not want to be shorting this here. Why? Because you're shorting after we already distributed. Now we'll get to this later. Let's go lower. ERL, IRL. This is the two types of liquidity that we look for, or not that we look for, the algorithm looks for. That's the foundation of candle creation and the system that runs it. Now you understand how candles are created, what the power tree is, you understand premium and discount. Let's go a little bit deeper. But what are the actual goals of the algorithm? It's not just high, low, high, low, high, low, high, low. The algorithm price literally only does two things. One, it fills imbalances, and two, it grabs liquidity. These can be divided into subcategories. It goes from discount to premium, and it goes from low to high. There are two names for liquidities that price targets. All price once, and is programmed to do is the balance between these two objectives written above. There's another name for those. ERL, which is your external range liquidity, highs and lows. And a very simple way to memorize this is that external means outside. Highs and lows are outside of a range, right? IRL is internal range liquidity, which is your imbalances, which is your fair value gaps, which is your new week opening gaps, which is your new day opening gaps, which is your volume imbalances. If you don't know what those are, please go study a little bit. If I want to pack everything about ICD concepts into this video, it would take 6 hours of recording. That's why I said you need a little bit of understanding. So for those who were wondering and had your questions at the start, this is where fair value gaps come in. From IRL, which is imbalances, which is your discount, we go into ERL, which is your highs and lows to premium. This process repeats non-stop. And as mentioned before, imbalances are fair value gaps, new week opening gaps, new day opening gaps, volume imbalances, and way more. If you come to here, I've drawn a few candles for you, and I know it doesn't look the best, but you get my point, okay? We have some green candles here. This is a fair value gap in between those candles. And here, imagine that this is the 930 candle, okay? And as you know, the 930 candle is what we trade the most, what we like to trade the most. If this is the hourly candle, then this is the 9 a.m. candle, right? 9 a.m. open, 10 a.m. close candle. We open, we go all the way lower. We dip below this low right here, this low right here. Why do we not just call these the discount level? Because you might be wondering, right? And this might be your issue as well. How do we know which high and low we are most likely going to target? Well, there are two things to understand. The reason you don't find the right level to trade off of is two things. One, on the higher time frame, there's nothing there, and it's literally a low. So many of you will wait for 930. 930 sweeps this low or this low, and you try to long from these two lows here. What happens is you get stopped out. But if you truly understand what the market targets, you realize, wait, there's an imbalance down here. That's my IRL. That is my internal range liquidity. You would wait for the internal range liquidity to be swept so that we go into true discount. And then you could look for trades. When we go into here, we are discounted inside of an IRL while the candle is setting in its low. Manipulation, open, low into manipulation, discounted prices inside of an imbalance, which is a higher time frame fair value gap in this case, meaning the market has reached the first objective. Cigarette number 3 while recording this video. So the market has reached objective number 1. Now it must reach objective number 2. Objective number 2 is discount to premium. Objective number 2 is IRL into ERL. Manipulation to distribution, low to high. Then here, premium above an ERL, which is your external range liquidity, while the candle is setting its high in. Distribution, this whole move, plus H, which is your high, so we're setting the high in, plus premium prices above this high right here, or even this high. Actually, the correct one is this high, because all we're doing right here with this whole price action is we're analyzing the lower time frame movement of this candle, plus ERL, which is your draw liquidity. This is literally what the market does. And it does this by balancing between time frames. And as I said, the time frames are fractal. So here, this could be a daily fair value gap. This could be a 4-hour fair value gap. This could be any time, my friend. Let's move lower a little bit and understand the formula, okay? I actually went ahead and got a picture of my old script, somewhat, so I don't really miss. I didn't want to miss out on something. The old script was a little bit more complete, okay? The formula is as manipulation, which is either IRL or ERL, which is either high to low or low to high. In other words, open, high, or low. Opposites would be, the next move would be distribution, which is from ERL to IRL, or low to high, or high to low, which is open, low, or high. Oh my god. Goddamn VPN extension. Price repeats this system off of time. Put another YouTube video that dives into time. I'm not sure if I have a video on kill zones or times, but I'm definitely going to record a video on time cycles. There's a whole study that can be done on that. There's a whole new way you can understand that. For now, if you really want to learn about time, just go on YouTube and search up ICT time zones, ICT kill zones. If you really want to dive deep into time, you can go on YouTube and watch videos related to Dai's quarterly theory. He explains it very well. Now I'm going to make a video explaining his quarterly theory pretty soon. This right here is not his quarterly theory. This is something else. This is me just dividing a candle into 4 parts, which is the open, low, high, close. That quarterly theory relates to time. And here we have an image of my old script, which was a little bit more complete. So we have accumulation, which is your open, and then manipulation, which is either your high or low. So we go from manipulation to, for example, here low, which is either your internal or external range liquidity. then distribution to premium, opposing range at the top side, manipulation to high, which is either your internal or external range, liquidity, which is premium. So discount is at the bottom, premium is at the top, right? And then we go from premium to discount right here, or discount to premium at the bottom, opposing onto the opposing range, right? So if we're at the bottom and we are inside of a discounted level, we obviously want to reach towards a premium level, which would be the opposing range at the top. And here, if we create a low, then we're going to distribute and create a high. If we create a high, we're going to distribute and create a low. Why are we going to distribute? Because we've already manipulated. Manipulation sets the first kind of direction in. And here, if you divide a candle into 4 parts, this also tells you which is the best time to find an entry, right? So I actually have to draw another line, I think. I'll use the red one for this. That's not red. This is red right here. So something like this. Now we've divided this into 4 parts. This is your open, this is your low, this is your high, and this is your close. The best time to trade is the low or high. Is quarter number 2 or quarter number 3. Let me drink some water real quick. So, damn, my brain. So, every candle can be divided into 4 parts. Now, you know every candle is made of 4 parts, but we're essentially displaying those 4 parts in a different manner. Okay? There's 2 ways to draw a candle. The first way is literally just a candle. That's the first way. And the second way is by drawing it using time. This is time. This right here can be divided into 4 parts. This right here can be divided into 4 parts. So for instance, this is the open, this is the low, this is the high, this is the close. This here is the open, this here is the low, this here is the high, this here is the close. The only difference between these two is time frame. This could be an hourly candle. This could be the 1 minute chart inside of that hourly candle. You're essentially looking at the same candle, but just on different time frames. That's all that it is. There's nothing else to it. There is nothing else to this. I'm trying to think if I've missed anything. I haven't missed anything. This is literally it. Now let's move on to here. Shifts in order flow. Now, how do we use this knowledge to our understanding to look for a trade? As I've mentioned here, the best time to trade is literally down here. It's the manipulation change to distribution phase. And we want to look for that using a concept named the CISD. CISD is a change in the state of delivery. So in this case, we have the open, then we have the low. Here, so let me actually draw something like this. This here is quarter number 1, this here is quarter number 2. This here is quarter number 3. Now 4 is just the close, whatever. Between these two is where you find the best entries. And you look for that using CISD. CISD is essentially a shift in the state of delivery. But what do I mean by state of delivery? If you look at the piece of price action here, and I'll find examples on TradingView for you after we're done with all the theories in this video, we're almost at the end, is that we are literally only making lower lows and lower highs until we suddenly shift and we break through one of those lower highs and we create a higher high. This here signals to us that we aren't respecting bearish PD arrays anymore. This signals to us that, hey, we are probably switching from bearish to bullish. This is what you want to look for when time is right. Now, I've mentioned before that market runs on time. And I've also mentioned before that your strategy is probably not wrong in your execution is. Your time-based execution is. So you execute on the wrong time. For instance, here, if we're closing and you short here, you're probably going to get stopped out. You do not want to short here. You do not want to short where the candle's closing. Why? Because it's already distributed. It's just a close, man. It's just the close. It is just the close. You wanna trade before the distribution starts or as we're distributing, targeting a higher time frame draw on liquidity or any draw on liquidity on the other end. Here, you have your change in state of delivery, we respect it, then you can look for longs. So the golden confirmation for you would be, first of all, check. Have we tapped into ERL or IRL? For instance, in this old example right here, we tapped into an IRL. So that's confirmation number one. Confirmation number two is, are we trading the right time? Here, we are in the manipulation phase because this candle opened, went lower, and then has to go higher. So yes, we are trading at the right time because we still haven't set a high end. We have to set a high end, correct? And confirmation number three, CIST. Have we changed order flow from bearish to bullish? Yes, we have right here. So everything is aligning. There is one extra confluence that I want to teach you. It's not really related to the market engine. Actually, I lied. It is related to the market engine. Somewhat, at least. It's more of a confirmation. It's more of a confluence. It's called an SMT. In other words, a cracking correlation. Most assets are correlated, meaning, well, not most, honestly, every single asset on the planet is correlated to another one. Most assets are correlated, meaning they follow each other almost the same way. For instance, NASDAQ and the S&P 500. A cracking correlation, also known as SMT, is when one of the correlated assets behaves differently. This is a strong signal that a possible reversal is on its way. This, alongside everything I'll tell you in this video, will give you an inhuman entry model. So, an example right here is NASDAQ takes this low right here and then shifts and continues higher, while the S&P does not sweep that low. So on NASDAQ we have a lower low, on the S&P we have a higher low. That's the only difference. This shifts, or this signals a possible reversal because the assets are uncorrelated. One of them is stronger, one of them is weaker. Now, a common question that I get is, Androgen, when there is a SMT, which one of the pairs do we trade? The one that swept liquidity or the one that did not sweep? My answer is that the one that did not reach the level that the other one did, for instance, in this case, the S&P 500 did not sweep. That means it's way stronger, right? Because it didn't have the weakness. It wasn't weak enough to go all the way down to that low. But this doesn't necessarily mean that... God damn. Sorry. But this doesn't necessarily mean that you only have to trade the S&P. You can trade both. And the reason behind that is, if the S&P is stronger than NASDAQ and it's going to fly, it's going to also push NASDAQ up with it. But if you want the correct answer, the best one to trade is the one that does not sweep. That is it for our script. Let's now move on to TradingView and see what we can see now. Before we go on to TradingView, I have a pretty slow internet connection, so if TradingView is a little bit buggy, my apologies on that. Now, We're on TradingView, and I'm going to break down a trade of mine that I took yesterday. And this trade was based on order flow, right? And it was based on everything that I taught you in this video. First of all, let's pay attention to the higher time frame, right? So on the 4 hour, we have this up move and then a displacement. That's your shift. That's your shift in the state of delivery. And we had if you genuinely pay attention, we had a inversion right here. So this fair value gap was respected here. As you can see, price traded back into it, respected it to bounce higher. And if you look at the bottom, 9 a.m. So if we took a long here, good job. And then we broke down. We broke down. This fair value gap became an inversion. Later on, we left this inversion as our little change in the state of delivery, and we left two internal range liquidities. And you might be confused as to, no, Androgen, what do you mean by internal range liquidities? How is a fair value gap a liquidity? A fair value gap is a liquidity level because if you go in the lower time frame, after you mark out a fair value gap, for instance, this level right here, this is the beginning of this 4 hour fair value gap. That level you marked on a lower time frame is quite literally just a high. So fair value gaps on a lower time frame are highs and lows. You see what I mean by that? If you understand ERL and IRL and this video altogether, a lot of your questions will be answered. So you're confused as to which high and low you should be targeting. You see the charts and you see two equal highs right here. And you try to go for a short anywhere here, you get stop bouncing. You're wondering, why did it not respect, sweeping these highs? Why did it go for this one? Your question will be answered if you look a little bit deeper. If you understand that price has to first tap into an IRL to then go for an ERL, you will understand what levels to look for shorts. In this case, price tapped into an IRL by sweeping this high. And by sweeping this high, we do two things. One, we tap into that inversion. And two, we tap into that 4 hour fair value gap. And I'm pretty sure if we mark this level right here on the lower time frame, this is where that 4 hour fair value gap high is. And I was right. That low right there is the, well, actually, no, I was wrong. Damn. So if you go in the lower time frame, if this lets me draw this correctly, Jesus, please. This right here is a low, this right here is a high. And between these two lows and highs is a higher time frame for value gap. So what price does is we change in the state of delivery. We form a CIST. Then we come back up here, respecting those IRLs that we left behind. Again, we once more come back into here, into that level, respect it. When do we come into that level? 9 a.m. We respect it. So we have went from IRL, which is this level right here, respected it. Now we could be looking to target ERL. Digging a little bit more on the lower time frame, we can see that at 8 a.m. we started moving towards that 4 hour fair value gap. On the hourly, there's multiple ones around, whatever. Come all the way up here, respecting that 4 hour fair value gap. And then we start moving lower. So the order flow that's shifted from here is still bearish. Now, how do we use this to our advantage? We understand that, okay, now price is probably targeting previous week's lows. Why is it targeting this week's lows? Because this right here is a higher time frame ERL. And do you see how everything that I taught you is coming together in here? It's 24 hour again. This This week's candle just opened, right? Monday is right here. Today is Tuesday. Candle opened. It's trading all the way lower into this level right here. Open, low, accumulation, manipulation. Here is where you look for trades. That's where it's highest, the highest probable. And then it has to set a high in. Now it could be a little messy. It could go all the way lower here. Then in one day, set a high in. But it's textbook. It still is ran by the same principles. This short that I took here, which I'm explaining to you slowly, is based on these same principles. Go back on the 15 minutes. You can see here that some stars are aligning. So big move, up move, shift in the state of delivery by displacing this fair value gap here, coming back into it, respecting it, continuing lower. I know prices either targeting this. Why? Because that's the low of the day. That's the lowest price given in the day. And if I'm trading, I just want this. It's possible that we take the previous weekly low another time. And also, if you were to draw, oh my God, it's so crazy how we can go very fractal in candles. Because a candle isn't just an open, low, high close. It could be fractal and do something like this. Open, low, high, close. Look at this right here. So the Tuesday candle opened. Well, they opened at 18, I think, right there. So the candle opened right here, went a little lower, came back a little bit here. It could now go reach for previous week's lows and then do this. Or it could have opened right here, went a little bit lower, went high to, for example, speak this high, went all the way lower and then higher. But it still aligns. You just don't want to trade the close though. That's the only thing you have to be careful about. You do not want to be trading the close. Now, shift in the state of delivery, targeting this low right here. Internal range liquidity, external range liquidity. You might be asking also Androgen. There isn't a fair value gap that we haven't tapped up right here. We've already tapped into that fair value gap multiple times, and you would be correct. So even if there is no IRL here, imagine it's just a random high. Are we trading towards the price's objectives? In this instance, after we shifted here, price's objective is to come back down here and fill in this imbalance. So I don't care if there is, an IRL that we tap up here. I don't care about anything. I'm trading towards price's objective down here, which is previous week's lows, targeting that higher time frame imbalance that we set in place. So you don't always want to look for everything. You essentially want to ask yourself, hey, are we targeting price's objective? Which in this case, it's very obvious that we are objectifying previous week's lows and we are trading towards that. So what I did was on the lower time frame, 91 minutes. At first, I didn't really get any entries. 9:30 open here, just a complete down move. Here, I just took a little scalp. We sweep the sign right here, 2 equal lows with our draw on liquidity down here. And I just used this right here to go short. Done. All of that preparation and all of that studying at the market led to this one scalp. And it's kind of brain dead. If you put every single rule together, do you see how easy it is to understand price? I understand price wants to reach this level. I understood all the way from here. In fact, I knew from all the way here that price must reach this level. I'm just waiting for price to give me confirmation and give me a clean setup to trade towards that objective. Based on this video, your sole purpose when it comes to trading should be finding the objective of price and where price wants to go, and then trading towards that draw and objective. In this instance, we know price is most likely, looking to reach for previous week's lows. RB, is our trade aligned with that objective? Yes, it is. You should never marry your bias. You should never marry your, what you have in your head. In fact, you should never try to predict. I'm not predicting that we're going to go to previous week's lows. I'm reading price and it tells me that we want to go for previous week's lows. We could have just tapped an hourly gap in here, or like a 4-hour fair value gap, for example. We could have came back all the way down here, tapped this and went higher. We could have shifted direction here and went higher. But all I'm doing is I'm studying price, right? I'm just looking at price and I'm asking myself, what does price want to do? What is it telling me? It's telling me that, hey, we shifted direction here. This is my order block. We come back into the order block level right around here, into this inversion, whereas we respect it and we continue bearish. That's all it's telling me. It doesn't tell me, hey, look, we disrespected this and we're going higher. No. It's telling me that we respected that change in the state of delivery and we're going to continue lower. So your goal in trading should not be to predict. It should be to analyze and understand what price wants. In this case, price wants to go lower. And if we go back here also, you can see the same pattern happen down here. Now, I wasn't on charts until like around this level because internet connection outage, but it's very clear what price wanted to do here. 2 draws on liquidity left, price tapping and sweeping. And look, if you just trade based off of the sweep, that, oh my god, we swept, this low here, you would get stopped out and utterly destroyed. But if you wait for confirmation and if you wait for price to tell you what it wants to do, you would have sniped this move. And don't worry, price will do this forever. Price will give you hella opportunities. I'm not mad that I missed this entire move. No, I'm not. I don't care at all. Because there's millions of candles to be printed. Correct? Look right here. Price retraces into an IRL, continues higher. Retraces into an IRL, continues higher. Now, there could be an IRL down here. And that was price's objective, to go into that and then continue higher. If I were to get rid of this right here, you wouldn't know if this is the daily. You wouldn't. You could think this is the 1 minute. If I literally just take a screenshot of this, zoom in, you wouldn't be able to guess the time frame, and that's what I mean by time fractality. This could be the 1 minute. The daily candles behave the same way the 1 minute candles do. And let me tell you something shocking. Equal highs, we retrace into an IRL on the 3-month time frame, and then we go bullish. And then we go bullish. And we've done this before. There's an SMT here, but we tapped into this here. Again, IRL. Again, coming all the way down into an IRL, and then moving up. And here's, again, this is where my point stands. You don't want to predict, because if you're predicting, you could also say that the price might be going into this level right here. Did price go into this level? No, didn't give a fuck. It went into this one. Don't predict, analyze. If you analyze, you would know, okay, price went into this level. Now it's getting stronger, bam. If you're predicting, you might have said, oh wait, price might want to come down into this level. All price did was tap this continuation order block, continue higher. Shocking, right? What do 6 months look like? Nothing. But under 3 months, there you go. Internal range liquidity, continue higher. It's literally as it's brain dead, isn't it? Price does this on every single time frame, guys. On every single time frame. And look, if you look at this piece of price action right here, it kind of looks like the trade I took yesterday. Right? Sweep, target wrong. Oh man. And let me also show you something shocking on Bitcoin. That if you guys know me, which if you're on my YouTube channel, you probably still aren't on my Discord server. I mentioned from Bitcoin was around 115K that we're going to go to 60K. And that's exactly where we went to. If anything, to be specific, I called 66K. Internal range liquidity. We're going 12 months. Internal range liquidity. And now we're getting ready to fly towards this right here. It's the same fucking concepts, guys. It's the same thing. It repeats no matter the time frame. You see how I'm using IRL to predict a big Bitcoin dump, and now I'm using it to predict a big Bitcoin pump. And if you go on the daily time frame, look right here. It's this low. And price is now slowly shifting direction. If you go on the weekly, nothing right here. There's no IRL. But look, fair value gap. Right now, it's not respecting it. Once we inverse this, we're gonna fly. I hope this video helped you. If you've watched all the way to the end, if you've genuinely taken notes, if you genuinely go apply this, if you genuinely watch this multiple times, if you understand market fractality, you are gonna kill it. The market engine video is now finished. If you want to be privately mentored by me, join my Discord. I have my own mentorship thing there. I'm a guru, guys. I'm a guru. I have a course. Kill me. But that's the only way to support me. Thanks for watching.